Good day, everybody, and welcome to this month's edition of our IFRS and Corporate Reporting webinar. Now, this month, because it's spring and it's September, we are looking at Spring Clean Your Balance Sheet. Thank you for joining us, and we hope you find it informative. Now, as always, I'm joined by my fellow partner, Kevin Frohbus, and the interesting thing is, usually I join and present these webinars from Melbourne and Kevin presents from Sydney, but today we're sitting in the same room. I'm in Sydney this week, so we're having a lot of fun. Lovely to be together. And then very exciting, we have Christine Webb, one of our IFRS and Corporate Reporting directors here in Sydney, join us to present this session. So the two key presenters today will be Kevin, my normal partner, as well as Christine. So Christine, thank you for joining us. Thank you for sharing your wisdom and experience with our clients. I would like to start by acknowledging, I would like to begin by acknowledging the traditional owners of the land on which all of us meet today and pay our respects to elders past, present and emerging, and we extend that respect to Aboriginal and Torres Strait Islander peoples here today. Now, today in Sydney, the three of us are meeting on the land of the Gadigal people of the Eora Nation. And, you know, if you can potentially in our chat box, put in where you are meeting, and that would be interesting to find that out as well. Now, today's agenda, Spring Clean. Economic and sustainability considerations when you're doing your spring cleaning, financial statement presentation cleanup items, looking at financial liabilities, especially getting in an order before 31 December 2024, other spring cleaning ideas, and then also how are financial reports changing. So quite a number of items to have a look at today. So before I waste too much time, Kevin, straight over to you and Christine, and I'm looking forward to the webinar today.
Thank you, Aletta, and it is good to have you here. Sydney has put on a real show with its heat wave. We've shown these Melburnians exactly how it's done. So welcome to Sydney. And if you notice me looking up above my computer screen, it's because I'm actually making eye contact with Aletta straight on the other side of the room. So lovely to be here. And also Christine is on my right. Christine, it's lovely to have you. Welcome.
Thank you.
Christine is
inviting me.
Being here in Sydney for, what is it, 4 years? And so we're very happy to have you. We tried something new today. So I'll just quickly, running into it, the purpose of today's agenda is actually to share with you a number of fact patterns that have come to us recently that essentially have been driven by changes in the economy, some sustainability issues, but also just an opportunity to clean the balance sheet up, which is exactly what's on the agenda. I'll apologize off the bat because that 31 December should be 31 December 2023. So that was just there to make sure you're all paying attention before we jump in. But this really is targeted at an opportunity to look at what the accounting is telling you, looking at what your balance sheet is telling you, and an opportunity to change not only the financials, but also perhaps how you can integrate that into your business model and your strategy. And talking of strategy and talking of matters related to, you know, the finance function and the CFO, I would like to actually just make you aware, especially if you're a CFO on this webinar, that straight after the webinar today at 12 o'clock, so we'll have to be finished by 12, BDO is presenting another webinar with one of our partners, Nick Fox, and we've also got a representative from ACCA or ACCA, Brendan Sheehan, and they'll be talking about the evolution of the CFO and the CVO. So that's straight afterwards. You can click on the link there in the notes we've sent you to actually register. It will also be recorded, but that should be interesting for you as well. So let's get into some of the economic and sustainability considerations. This is me layering the context or the economic highlights, shall we say, or FY23, which has led us to some of the fact patterns in today's presentations that we want to share with you. And I've taken this from an online blog. This is from John Addis, really just reporting on the FY23 highlights. to give you a flavor of what we're seeing out there economically. And the short message is, in the context of ongoing wars in Ukraine and rising energy prices and supply shortages and inflation, what we're really seeing is a bit of a mixed bag. There's still a lot of entities that are reporting profits, even though it might have dropped. There's still entities that are reporting profits, even though their cash is down, and the other way around, profits and lots of cash. And we're also seeing an uptick in dividends. We're definitely seeing entities declaring dividends. There is a lot of cash still sloshing around in the system, and that's not only at the ASX level, that's also in large proprietary companies and family organizations who are restructuring. And that's really going to set the context for the types of fact patterns we have in today's presentation that would be ideas for you to think about when you're spring cleaning your balance sheet. These are the highlights. We are seeing dividends, we're still seeing profits, we are seeing a stabilization of interest rates. So the outlook isn't as bad as it seemed 6 months ago. And then finally, and we cannot get away from this, is that climate transition and ESG transition is an absolute feature of the boardroom at the moment. And it is starting to filter through to financial reporting. So we'll talk about that too. So without further ado, I'm going to hand over to Christine, who's going to deal with the first of those themes, dividends and dividend traps. Christine, over to you.
Thanks, Kevin. So we're going to start off with dividends. As Kevin said, when we think about paying a dividend, we often jump straight into the Corporations Act test. So we can see here there's a three-part test. The first part is an asset test. The assets have to exceed the liabilities immediately before the dividend is declared and immediately after the payment of the dividend. There's also a reasonableness test and a creditors test. This all seems relatively straightforward and, as I said, immediately what we jump to. However, there's a lot more involved in paying a dividend, and I expect most of you are familiar with that. I'm going to try not to look at Kevin every time I want to flick to the next slide. So we are not lawyers or tax experts, so obviously we encourage you to get advice on when you want to pay a dividend, but there's a number of things that we want to consider. So what I showed you with the Corps Act, which was introduced around 10, it didn't actually replace the need under the common law for a company to pay a dividend out of profits. So generally, we say when we want to pay a dividend, it not only has to pass the solvency test, but it also must pass the profits test. There are other things that you should consider. So think about whether there's additional rules in the company's constitution. You also want to think about whether there's a return of capital and what's going to happen with franked or unfranked when you're paying your dividend. Well, so why I wanted to bring this up is that, as Kevin alluded to, there's been some tough times, and we want to make sure that when we want to pay a dividend, we are able to pay a dividend. So the question that we keep getting is, what if I've got historical losses? We can see a little snippet over on the side. Imagine if I've got $1,000 of share capital, 350 of retained losses, which gives me a total equity of 650. So I've got positive net assets. And if we think about those tests in the Corporations Act test, it would look as if we can declare a dividend and not have any issues. But do we actually have profits to pay it out of? So let's go through an example. So let's set the scene. Entity A owns Entity B, which owns Entity C. First thing that I want to point out is when we do the dividend test, we're doing this at an individual entity level, not the consolidated level. So if we imagine that Entity C is the operating entity making the profits, got positive net assets, they can meet all of the tests and pay dividend up to Entity B. But if Entity B has got retained losses and the only income they've had in the current year is the dividend that they've received from C, then the dividend would get trapped there and they themselves wouldn't be able to pay a dividend up to Entity A. So there's two things that we're seeing in practice that I wanted to share with you. The first thing is the structure of the group. So in the example that I just ran through, we've got the structure on the right side there. A owns B, which owns C, and in which case to get the dividend up to A, we need to make sure it doesn't get trapped in Entity B. If, however, we had a structure like I've got on the left, where B and C are directly owned by A, then whatever is going on in entity B won't interfere with entity C's ability to pay the dividend up to A, which then may allow, assuming A can meet all of the tests, allow A to pay the dividend up. Now, possibly reorganisation is an option for you, but that obviously comes with a lot of other complexities and things that you would like to consider. But just think about how does your structure work for you, and you can explore any opportunities you might have to restructure to help get dividends out. The next one is to create a profits reserve. We've seen this done in the past. It does sometimes get a little bit controversial, but one of the things that is great about equity, and I'm going to talk about this a little bit more later on in the presentation, is that there's times when there are things that you can do and move things around within equity. Sometimes there's strict rules over what you can do, but sometimes there are no rules on what you must do within equity. So in the little example I've got here, they've made a profit in the current year. So following that example from before, we're looking now at entity B. Entity C has paid the dividend up to us, so that's our profit for the year of 100. It goes into our accumulated losses retained earnings as per normal. That's what the accounting standards dictate that it does. But then in the year that I have generated that profit, I can transfer that into a profit reserve. And that profit reserve can quarantine it for accounting purposes, and then I can pay a dividend out of that profit reserve in the future, and ideally meeting my profits test in order to pay a dividend, provided we're complying with all of the other conditions. And I'll hand back to Kevin.
So thank you, Christine. And that's a really good introduction into sprinkling your balance sheet, because as Christine has mentioned, we've actually gotten a question linked to this or these types of fact patterns quite a bit. And that is because entities who may not have previously been dividend paying, or maybe they weren't structured, the group wasn't structured in a way to pay dividends. Maybe they were looking for an exit event through an IPO or selling it to somebody. Their strategies have changed in the economic environment, and suddenly these entities are not looking for an exit event. They're not looking for an IPO, but there's cash trapped in the structure somewhere, and they're trying to get it out. I think the point with the session there is understanding what your future dividend strategy is relevant not only to just making the profit and distributing it, but also understanding how it gets out of the entity, following the law, following the tax considerations, but also linking it back to what your accounting policies and your accounting profit is telling you, because obviously there is a test there that still needs to be satisfied. So that'll lead me into my next section, which is accounting policies. And this is linked to the section that Christine was dealing with. And the reason for that is, by itself, accounting policies is relevant to accounting profit, which ultimately, as Christine was discussing, actually has an impact on the ability to declare a dividend, always linked. So I'm going to run through accounting policies and actually just add a new spin onto something we've done before. So here's the spring clean part. It's a new take on something old that we've done before. Probably about 12 months ago, maybe 14 months ago, Aletta and I did a series on accounting policies, and these next 2 or 3 slides come out of there, talking about what our accounting policy is, and how do you select them in order to achieve various motives. Now, what we know with accounting policies, these are the specific principles, basis, conventions, rules, and practices that you apply in preparing financials. And the relevance in this particular case is, how do we recognize and measure assets, liabilities, income, and expense? That's what accounting policies are all about. In the presentation last year, the series on accounting policies we did, we spoke about an entity that's maturing, who's approaching a stage in their life cycle where they actually start to choose accounting policies that are linked to their business strategy. And the 3 strategies we had on the screen during that series were profit strategy, asset strategy, and no strategy. Most organizations in the startup phase, or who are small or early stage large proprietaries, probably have no accounting policy strategy. That's not a bad thing. It just means that they prepare their financials for compliance purposes, either for tax or for lodging with the regulator. But as the entity progresses through its life cycle, it starts to select accounting policies that are linked to its life cycle stage. And if you take, for example, an ASX listed company, they're probably going to design their policies in many ways to align with the business model, which is profit-based. You want to maximize your EBITDA because that's linked to your return on equity for your equity shareholders. Asset strategies might be something that you adopt if you've got a capital maintenance strategy. And I always say, if you're an entity that's looking to IPO and you're in an R&D phase where you're trying to develop a new technology, you might choose a capital maintenance or an asset-based strategy. So there you'll look to accounting policies that capitalize development costs, for example, instead of expensing them. So to complement that presentation from last year, I'd like to add a new strategy, which is my strategy 1B, and that is my dividend strategy. Because more and more, as Christine has pointed out, we're starting to see entities that have not considered dividend trap in their structures or the way they choose their policies or the way that they present their financials. And so now they've suddenly found themselves in a trap scenario because their accounting policies didn't align with the strategy of managing accounting profit with the purpose of declaring the dividend. So I'll leave that out there for you. But other than to say, which is what I've highlighted at the bottom of this slide, is changes in the economy and changes in the climate-related transition and changes in the fact that we're still in a scenario post-COVID where there is a lot of cash sloshing around, but entities don't have a clear exit strategy through IPO disposal. Now's the opportunity to actually plan your long-term strategy in terms of how you're going to run the business, what the exit strategy is, what's your dividend policy, and make sure your accounting policies align with that, not only in the current year, but also in the future. Now, bearing in mind, you can't always choose your accounting policy, but there are certainly ways in which you can align accounting policies with what you're doing in your business in order to tell the story about your business in your financial statements. And I've already mentioned a couple of examples there that you might want to explore. Things like cost capitalization. You might be looking at a group reorganization to release the dividend that's trapped in Christine's example where A and B and C were on top of each other. You might be looking for a group reorganization going forward to try and release the dividend. You have to choose an accounting policy to account for that combination. And you might also have a look at things like property and whether you might want to adopt a fair value methodology if you want to link your balance sheet to an asset maximization strategy rather than, let's say, a profit mode. So those are some ideas for you. While I'm at this, I will talk about something else that keeps popping up. My favorite topic is goodwill and impairment. It's a topic that won't die, and that's because entities still are dealing with M&A and the goodwill that arises. If you are going to look at things like group reorganizations, or if you're changing the operations to change strategy because maybe you're no longer looking to sell the business, but you're looking to actually reorganize it and spin different units off, you might find yourself in a scenario where you've got goodwill from a previous acquisition that needs to be dealt with. There are three situations in accounting where the goodwill that's on your balance sheet should be allocated between CGUs in order for you to set up an impairment test. The first one is actually if the goodwill's arisen in a combination in the current year and you haven't actually finalized the accounting for that acquisition. So that's if you've just gone through an M&A. But the two relevant ones here are if you're going through a reorganization or a restructure or something like that, you may want to consider whether your goodwill, which is assigned to CGUs for impairment tested, may need to be reallocated between new CGUs depending on how you've either restructured or reorganized the entity, or you may actually be setting the entity up for disposal, or you maybe there's a business unit that you're looking to dispose, and you've got to make sure in that case that you actually allocate goodwill to that CGU for disposal. Please don't forget this. It is important. It's often missed when entities are restructuring. It's often missed when entities are looking to sell a business unit, and they're so focused on actually the restructure or the disposal that they don't actually check what's going to happen to their financial statements on the disposal or on the reorganization. And often what ends up happening, they get to audit and they suddenly realize the auditors will say to them, hang on, but you've actually disposed of a business unit and there's some goodwill that goes with that should have been written off. And what happens is it contributes to the loss, makes the loss bigger or makes the write-off bigger, and that comes as a bit of a shock to organizations. So when you're looking at all this stuff, just make sure you keep an eye on the goodwill and you make sure you know what's going on there. Common errors in practice. when you're disposing an entity or you're reorganizing an entity, reorganizing a business, the first error is you don't actually do a reallocation for reasons other than the 3 limited above. We do find that some entities will sometimes reorganize their legal structure, but actually in economic substance, nothing has changed. And they do it because they're trying to achieve an outcome with the goodwill. That's a common error. But the most important thing is when you're disposing or when you're reorganizing, it is important to keep track of where the goodwill starts, where the goodwill ends, and make sure the emerging business units or CGUs or the disposed of CGUs or business units get their fair share of goodwill through that transaction. And there are ways to make sure that you actually maximize or minimize the goodwill write-off to achieve the right outcome aligned to the purpose of what you're doing, so that there's no nasty surprises when you get to audit. I have given you a link to the guide on our website where those examples came from, but it's just something to keep in the back of your mind. Right, let's talk with some basic financial statement presentation cleanup. So I'm going to hand over to Christine again. Christine, take us through some of the equity things again.
Thank you. So as I said before, there's a lot going on in equity. We get a lot of questions from clients. I've got all of these accounts in equity. You know, what are they? I don't know what they're there for. They've been there for so long. Can I clean them up? Mm-hmm. And as I alluded to before, there is often a lack of rules about what we can do in equity. There's obviously specific rules over specific things. Share capital is a big one, and to be honest with you, there's more rules from a tax and a legal perspective on what you can do with share capital. So of course, don't be tinkering around with your share capital. FX reserves, hedging reserves, you know, PPE revaluation reserves. Again, the accounting standards are quite prescriptive with those. It tells you when to put things in. It tells you when you take things out, which things need to get recycled to the P&L, and all of that. So those ones, again, should be pretty stock standard, and those should all be reconcilable. You should be across those. One of the common ones that we get is questions over the share-based payment reserve. I've got the share-based payment reserve. I've had it for so long. I don't even have any share-based payments. What can I do with this? So let's go through an example. We've got Spring Cleaners Limited. I love the name of this company, Spring Cleaners Limited. So we entered into a share-based payment arrangement 5 years ago. You know, we recognized the expense. Grant date fair value was $1 million. We've expensed it over the vesting period. But what's actually happened, they've all vested, everyone stayed, everything vested, they all received the options, but the share price actually declined, and so none of the employees exercised their options. So all of a sudden, I've now got this share-based payment reserve, and none of my employees actually, you know, ended up with any shares. What can I do with this balance? So what we can do, now it's important to say that we can do this, we do not have to do this. If you want to leave your share-based payment reserve there to accumulate, you are most welcome to do so. There is no rule on what you have to do once it goes into the share-based payment reserve. But if you want to keep things clean and tidy, then you can, well, after these instruments have expired, you can transfer the share-based payment reserve over to retained earnings. So as the example shows here, debit the reserve, credit retained earnings, and you've gotten rid of that balance. The share-based payment reserve in this instance is then going to come back to nil. What that means is you can keep your share-based payment reserve only ever open and existing for instruments that are currently on issue, that haven't yet expired. So that's just one example. We often find there's other, you know, often remnant little balances within equity. And again, if they're not one of those specific things that have specific rules, you are welcome to tidy those up. My general rule of thumb within equity is to make sure that what you've got within that account is what your accounting policy says, what that balance actually represents. We've got a link there for some more information on share-based payments.
Christine, can I ask a question? Can I take that reserve back through profit?
No, you cannot take it back through profit. So that is a great question. Thank you, Kevin, because once something is in equity, unless the accounting rules specify that you can take it back out of equity, so some of those specific reserve balances and things must be recycled through equity, but unless the accounting standards explicitly allow you or require you to transfer them to equity, they're out of equity, then they must stay within equity, and you can only transfer within equity.
I think this is probably, I've got to say, one of the bigger questions we get is this one. It seems so easy and so uncontroversial in ways or forms, but it does actually bother a lot of people who they see this on the face of the income statement and it hangs around. You know, sometimes the reserves are hanging around for 5, 10, 15 years after the shares vested or were granted, and no one can understand why it's sitting there. So it's a great example to spring clean your balance sheet on this one. And like Christine said, you don't have to do this, but you can.
Absolutely. Okay, so while we're on the theme of presentation items, I wanted to remind everyone about the regulatory guide on non-IFRS information. So this actually came out way back in December 2011. So if you have forgotten about this, if it's slipped your mind, then this will be a great little refresher. The first question is, what is non-IFRS information? We're so familiar with IFRS that one would question, what is non-IFRS information? It's financial information that is presented other than in accordance with all relevant accounting standards. So a couple of those, I'm going to go into an example, but a couple of things is extraordinary items, you know, normalized profits, those things that are trying to add different language and terminology from what we actually use in the accounting standards. So this is an example of one that was in a recent ASIC media release, and I'll include that link so as you can have a look further for yourselves if you wish. But they've included a line item here, as you can see, I've highlighted it: profit before depreciation, amortization, interest, impairment, fair value movements on financial derivatives, and income tax expenses for the year from continuing operations. It's quite a mouthful for me to get through, but you can see there they've added in a subtotal here to try to separate those other items: depreciation, impairment, interest, to try to separate that and in some way, shape, or form, you know, trying to normalize profit a little bit. Another example that we've seen was profit before depreciation, net finance costs, and income tax. So we have seen, this is just one example, but there are plenty out there of different line items that people are coming up with. And let's jump into the next slide. So on this one is, this was presented in the same annual report. So this table wasn't actually in the set of financial statements. It was in, you know, the operating financial review and all of the additional information that's included in the annual report. So again, here you can see where I've got underlying expenses versus expenses. I've got EBITDA and underlying EBITDA and underlying NPAT, and what this doesn't include in the annual report where it's presented is what is underlying expenses, what is underlying EBITDA, what is underlying NPAT. It's not describing what these actual measurements are. So following the ASIC inquiry, this company actually re-released the statement of financial performance, as you can see here, and they've removed that subtotal. Then this same company, when they released their FY23 results, have included this table. This is just their results announcement. This is slightly different from the table that we saw before, and this does include a little bit of description on what items have been excluded. What it doesn't include is a reconciliation. And if we look now to the key rules that the regulatory guide sets out, this is what it goes through. So we must not be adding line items or subtotals in the statement of comprehensive income, which is the example that we showed before. We can include some non-IFRS information, but we need to be careful in how we do present that. So IFRS information is to be given equal or greater prominence than the non-IFRS information. If we are including the non-IFRS information, we need to explain what it is, how did we measure it, what's included, excluded, and we can do that by way of a reconciliation, but we need to also make sure that we are reconciling that information back to the IFRS financial information that we can see in the financial statements. It needs to be consistent from period to period, and we want to make sure that it's not biased and being used to remove bad news. Once the accounting standards used to include extraordinary items and non-recurring items, but that has been long gone. And I think this non-IFRS information, the regulatory guide that came out, was a way of trying to, let's move on past extraordinary items and stop putting those back in the financial statements. One that we do see is regularly is EBITDA. And technically a non-IFRS measure, but it is a commonly used measure, and it does use obviously all of the IFRS inputs into that. So we can actually use EBITDA within the operating financial review. It shouldn't be included in the financial statements because it is a non-IFRS measure, but you can use it in your operating financial review, and you would include a reconciliation back to your IFRS profit if you're going to use that. Here's a couple of links for you to take you back to the guide to familiarise yourself, the media, the ASIC review that media release, and a recent corporate reporting insights article where we discuss how to use the non-IFRS profit measures. And I'll hand back to Kevin unless you've got anything to add.
No, look, I think it's an old favourite. It's a goodie, not a newie, but it is probably a good idea to kind of come back to it, because the aim of the financial statements has moved dramatically in the last 4 or 5 years to be simple, not obscuring information, get to the point, tell it like it is, not overcomplicated. So the guide itself, which Christine just ran through, isn't new, but it certainly has been used or cajoled in ways or forms that perhaps overcomplicate the story in the financials. And we want to kind of get back to, well, let's just get to it, make the point quickly, tell it like it is. And that leads me into significant accounting policies, because this is a very easy way to sprinkle in your balance sheet. And that's really just to tidy up your accounting policy notes. The accounting policy notes suffered for years from boilerplate disclosures. I mean, it wasn't uncommon in years gone past to have, the 4 statements of financial position, income statement, other comprehensive income and cash flow, and then have 17 pages of accounting policy notes and maybe 2 or 3 pages of additional notes supporting the balances in the financials. That wasn't that uncommon, and we still do see financials like that. So the accounting standards Center really did try to change the accounting standards to encourage simpler disclosure, streamlined disclosure, and one of the initiatives was actually just a very small change in wording to move us from the requirement to have significant accounting policies to material accounting policies. And what have we seen in that? A massive reduction in paper trail and boilerplate disclosures. An easy win. If you have nowhere else to start, this is one where you can start. What do they mean by material accounting policies? Really, assessing whether something is material is based on, obviously, the information needs of the user, whether it's likely to impact their decision making. And so if the accounting policy relates to a material transaction, event, or condition, and some other condition like it relates to a change in accounting policy, or perhaps it's something that has options in the accounting standard, like choosing fair value over cost in the way you measure your property, plant, and equipment, or if you've had to actually develop an accounting policy, so there's nothing in the accounting standards, you've designed your own, or it's a balance that has got some sort of judgment or estimate or assumption around it. Those sort of the characteristics that, when related to material transactions or event, should dictate the disclosing of an accounting policy that's material. You don't need to then include all the other stuff, all the other boilerplating, all the other paragraphs from the accounting standard that's actually already in the accounting standards, or might just not apply to your immaterial transactions or events. We have seen, in some cases, 10 pages come out of a set of financials just by applying this small change to accounting policies. So I'll leave it at that. I will link you to an article from one of our compatriots in BDO in Canada, 8 ways to make your financial statements say what they mean. Just some 8 tricks. When you draft your financials, put yourself in the user's shoes. If you can't make it past the first 2 pages of the accounting policies, the user's not going to be able to make it past those 2 pages either. So make it less. Avoid overload. Be entity specific. Say it simply, direct, and concise. And this links to the non-IFRS stuff as well. Get to the point. Avoid the bad news. Organize the information in a way that makes sense. Link between sections rather than repeating it. And say it in a way that boosts comparability. Now, this article that I'm linking you to here is actually an article from BDO Canada. The principles are the same there, But when I say boost comparability, it actually has relevance to our non-IFRS measures under the regulatory guide that Christine was talking about. Because if you're using non-IFRS disclosures that nobody else uses, no one can compare your financials to anybody else's financials. So avoid going in that direction and just bring it back to the things like EBITDA and the OFR that everybody at least has a working knowledge of and is comparable. So nice way to boost. Christine, want to say something?
I was just going to say, I think it's really relevant to streamline the accounting policies in particular. And we're seeing a lot more companies now put the accounting policy in the note with the, with the actual numerical information, which I think reads great. My favorite ones that I read have the financial information, all the numerical information, then the accounting policy and the significant judgment, all there in one great handy spot. So there's no more flicking between different notes trying to understand all of that different information. And I think if I don't have to read about the 5 steps of the revenue recognition model in an accounting policy, that's a big win for me, because we all know the standards, and I think we're very used to putting in all of that boilerplate disclosure. But let's focus on the entity specific thing. Tell me about what you do with your revenue. What are your performance obligations? How do they get recognized? So I think streamlining really helps. You can definitely see the benefit when it's been done right.
Good.
Okay, I'm going to keep going here and talk about financial liabilities. So the question is, where are your financial liabilities sitting on your balance sheet? Are they sitting in current or are they sitting in non-current? And I'm bringing this up because the current non-current thing has obviously been quite a hot topic, I want to say, for a while there's been several versions of different amendments come out with how to classify what gets classified as current versus non-current. I will come back to that, and I've got a link to an article about the effective dates of those amendments, because that's not the purpose of what I wanted to discuss today. But it's September now, it's spring cleaning time. For those of you with December year ends and same for June year ends, really, now's the time to be looking at what position are you going to be in come your next reporting period, and what are the implications of that? Have you got everything comfortably sitting in non-current? Is that where you want it to be? Or are we going to not meet some of our debt covenants? Is that going to trigger something to have to be reclassified and presented as a current liability? And what are the implications on that going to be for you? So what other key asset ratios have you got that are contingent upon that classification? There's a couple of things, I guess, that you can do now rather than wait until year end. So if you are looking at breaching some covenants and you want to maintain the non-current classification, are you in a position to obtain a waiver? It's very important that you be doing that now before year end. So we all too often, we see this issue come up right at the last minute, and those waivers get put in place early after year end. And unfortunately, that isn't going to get you the ability to classify that as non-current after when you receive that waiver after year end. The other item is whether you're in a position to renegotiate and refinance your liabilities and your borrowings accordingly. If you are going to be renegotiating or refinancing, just remember the modification rules, particularly the 10% test. So I'm not going to go into these now, but these couple of snippets are an extract from our videos, IFRS in practice. And you need to follow and work through, do you have a substantial modification or a non-substantial modification? There's a number of impacts in determining which one of those it is. One of those is whether or not you're using the original effective interest rate or whether you need an updated one, and what the impact is going to be to your profit and loss as a result of that refinancing and renegotiating. So just keep that in the back of your mind. I've included a couple of additional links in terms of the IFRS in practice, which has got quite a lot of useful information, particularly about modifying your liabilities. That reference there, 5.2.3.4, is where those little snippets come from if you want to jump straight into that part. The new rules about classifying your liabilities, they are effective. All of those new amendments, you now have to adopt them both together. They are effective from the 1st of January 2024. So for December year ends this year, they're not actually mandatory. you can early adopt. And if you are looking at doing so, you really want to carefully consider whether it is advantageous for you to early adopt or not. So don't just jump straight into that without thinking that through, particularly if you've got derivatives and other things as well as just plain normal borrowings. Now, no, I'm going to keep going. That's right. I've got a couple more things. So like a couple of other final spring cleaning ideas from us. The first one is discount rates. So interest rates are moving all of the time, and we get a lot of questions about what do I need to update, particularly around leases. We do a lot of lease management accounting, lease accounting as an outsourced service for a lot of our clients, and we keep getting our clients saying to us, interest rates have changed, our interest rates have changed, I've got to, what do I need to do? I've got to remeasure everything. The beauty with leases is there's a couple of situations when you need to use a new incremental borrowing rate, and other times you don't actually need to revise that. So you need to know when to use a new borrowing rate with your leases and when you don't actually need to use a new one. But with provisions, things like make good and restoration provisions and employee leave entitlements, you should be updating your discount rates. So just remember that and start getting prepared now for your December year end and making sure you're revising the appropriate discount rates that you need to. The last one here from me is just a reminder also about useful lives. So remembering again at each reporting period, we should be re-estimating what our useful lives are. So thinking also about finite periods versus, indefinite life assets. Has anything shifted to make something finite life? Reassessing what the useful lives are, and that goes through to what your residual value is as well. So keep that in mind, particularly for your property, plant, equipment, your intangible assets, and even remembering your right of use assets under your leases. And that's it from me. I'll hand back to Kevin.
Thanks, Christine. Always called you Aletta. I'm so used to it. That's very good, especially on the discount rates and the lease accounting. Just bearing in mind on discount rates or really interest rates in general. I saw a really interesting calculation the other day where the company had essentially calculated from their financial statements the weighted average discount rate of all its liabilities, and they compared that to the discount rate on the asset side, in particular in their impairment modeling, to essentially give themselves an idea of margin or how their cost of debt across the business, not just on their long-term borrowings, actually related to their market participant or their expected return on the asset side. An interesting food for thought to leave with you. It's no accounting requirement. It's just a different way of using the financials to help you run the business. And that brings me to how financial reports are changing. So we're in the final stretch now, bringing us to financial reports more generally. There's no doubt in the consulting and advisory work we do in myself, Christine, and Aletta's teams, and of course all the other advisory teams as well, that financial reports are more and more becoming a critical business tool to help the company tell their stories to capital investors. Now, when I say business tool, that's actually the key word here, because in years gone past, it was really just a compliance exercise. We have to lodge financials, say, here's our numbers, and off you go. And even some big listed companies in the past might have used that as a way to communicate with investors, but they didn't necessarily use it to drive their strategy and their risks. And more this is happening, even without the advent of climate and ESG, with IFRS becoming as advanced as it is, the information in the financials, if used correctly, actually is an important part of risk management and business modeling. And that has then been complemented by the drive for climate-related disclosures and also ESG more generally. I thought I would just raise this again because we do get questions on this a lot lately. I think, Aletta, you and I can actually attest to the fact that we're talking to more boards and CFOs than ever before on climate and climate-related disclosures, and in particular the Treasury consultation paper that's come out. Now, this paper is just that, a consultation paper. It's not quite final yet, so there is stuff still going on. But this is just for those of you who are listening and want to start thinking about how this is going to spring clean your balance sheet. This is relevant to that sort of thinking. The consultation process itself that's driving this, it's designed to bring into the financial measurement and recognition, and also the disclosure and presentation, the impact of transition and physical climate risks on the one side, how that links to the opportunities on the other side, how that drives strategy, risk management, and translates into financial information. This is not just something that's happening outside of the financial statements anymore. This is actually integrating into the financial impact, actually the numbers. How do the numbers change in the income statement, cash flow statement, and balance sheet from these risks and opportunities? It's always been there. No one runs their business without linking it to what the numbers are saying in the financial statement, but this is more so becoming important through this consultation process. Now, I'm going to put some of the ideas in the consultation process. Aletta will jump in at some point as well to add, but we've been talking about this for some time now. Where this is heading, or the intention of government, is that climate-related financial disclosures will be driven by the likes of IFRS S2 in the first instance, which is the sustainability standard on sustainability reporting standard issued by the ISSB on climate-related financial disclosures. It'll be in the annual report, part of the director's report, and if you're presenting an OFR, it'll be part of the OFR. This is linking to Christine's section on non-IFRS information, on business risks, on material risks. It's all going to be in there. And if you do have information dispersed through the annual report, we'll have an index showing where you actually put this information, where the metrics and targets are, and if metrics and targets might be reported in a separate report, like a sustainability report. But the intention is that this will be integrated into your annual report and financial statements through the Corporation Act being amended. What does that mean? That when directors are making true and fair declarations in their financials about the financial information that they're presenting in their annual report or their financial report, that declaration will also cover the climate-related financial disclosure, which means the existing common law and regulatory and legal provisions about duties of care and diligence will extend to those declarations, which also means that directors' liabilities will be amended to cater for it. Now, I'm not going to get into the detail right now. There are some proposed time limits on how those directors' liability provisions will be phased in over time. Bearing in mind, this is a consultation process at this point, so in a way, it's a statement of government intent about what they're planning to do. But I think it's fair to say, Aletta, that this is where we're heading in the regulatory sense. And so, time to start sprinkling in your balance sheet is also to start thinking about how this might look. It doesn't mean you necessarily have to react immediately to suddenly changing your financials, by December 23. But clearly, this needs to be factored into your thought process in terms of how you go about this. Now, I've put on here how this is planning to be rolled out. Also, not final yet. I hear there is some debate going on, and we all know that this is subject to consultation, which is what the purpose of a consultation paper is. But the aim of this is essentially to make this mandatory through the Corporations Act, leading up to 2028 at the end being Group 3, and that Group 3 at the end pretty much aligns with the definition of large proprietary companies. So the idea is all large proprietary companies or entities that at least are large proprietaries will be captured by mandatory implementation by 2028. And as you can see, there's a phased implementation there. So Group 1 starting as early as next year in the comparative period, where you have over 500 employees, $1 billion worth of gross assets, or revenue of more than 500 million. So 2 of those 3.
Kevin,
yes.
If I can maybe add on the mandatory reporting side, I think a lot of our clients look at these thresholds and think, definitely this is not us, or maybe this is us in 2027, 28. I think if people are trying to delay this and thinking it's not my problem now, they're in for a rude awakening. Because if you look at the financial statements and of the ASX 100 that's being published at the moment, so many of them in that Group 1 category, they often make reference already in there that going forward, if we do mandatory reporting, and let's use carbon accounting as an example. In order for us to accurately report our carbon footprint, scope 1, 2, and 3, especially 3, we have to push into our supply chain.
That's right.
So I think the conversation that we're having with clients at the moment is assess where do you sit in the ecosystem, the economic system. So who are your stakeholders? Who are your investors? Who are your customers? And how these people around you are impacted by mandatory climate reporting. And then think, what does it mean for you? So the fact that you don't fit into these buckets actually is not the most important thing. It's whether your stakeholders, your investors, your financiers, your customers, whether they fit into this bucket. Because you'll receive the phone call or you'll receive the email, and it will be stuff like, are you measuring carbon footprint? What are you doing around diversity, equity, and inclusion? What are you doing around privacy, cybersecurity? So not just what are you doing, come back to us with a statement on exactly what your carbon footprint is. Have you committed to targets? What are those targets? You now have to report to us every 6 months for half-year accounts or every year for full-year accounts. So the reporting obligations is going to come really fast, and we're already seeing that.
Absolutely.
Some of our clients are already receiving these emails and phone calls. So we work on both ends. We work on that big side where they are requesting information and we advise them to contact their suppliers, but we also work on the other sides where entities are being asked for information. So please don't be fixated by these numbers. Understand your place in the economic system.
Yeah. And I think bringing it back to this, I mean, we had an example recently where an entity currently would fit into Group 3, but actually based on where they want to be in 3 years' time, they would be in Group 1 if they achieved everything they were trying to achieve because they're going through a high growth phase.
Yeah.
And I think bringing this back to the purpose of today, the message from this is using financial information. What does it say about you is the purpose of your financial report. Moving you from compliance-driven financial state information to financial reports that reflect your business to your stakeholders. It's not just about recognizing assets and liabilities. It's also about actually what do you want your financials to say about you to your stakeholders, and what do your stakeholders want you to say about you as well, and using it as a tool is really what we're after here. So whether it's mandatory climate reporting or how you tell your story about EBITDA, or really coming back to where you want to see your dividends flow and how your group structure is set up, what is your why and how are you going to tell that story is really what spring cleaning your balance sheet is all about.
Yeah, and I think, yesterday I was part of a presentation and a panel discussion, and one of the things they asked me is, what would be your best advice for entities, any size entity in Australia at the moment, around sustainability reporting? And Kevin, for me, it is start. The best advice is to start. Develop a roadmap, but start, because sustainability reporting is continuous improvement. So make a start, do a gap analysis, understand where you fit in the system, understand who your stakeholders are, understand how their expectations might be changing. But critically, is to make a start and have a roadmap. And then they asked me, Aletta, so what do you think clients and entities in Australia are doing wrong? And I said, it's trying to think about a way how they can avoid this.
Absolutely.
That is the biggest mistake, because sustainability reporting is the way of the future. It will give you access to capital. It will continue to give you access to capital. It will give you access to people to work in your business, and it will give you access to markets. So they were laughing because my what to do and my worst thing were just contradicting each other. But I think that's the key message here.
And I think that just to kind of bring it all together, even just general financial reporting is a continuous journey of improvement.
Yeah.
Now we add climate and ESG on top of that, or climate reporting on the screen right now. And really, you're right, Aletta, start. Understand your why. Don't try and find a way through, because that's the wrong why. and maybe as a segue towards ending it, is if you want to start writing your first sustainability report, we've got a little article on the web that I authored and went out 2 days ago on 4 things to think about when starting out. But you know what? You can apply these even to your annual report. What to think about before writing it, purpose, etc. Now,
Kevin, I want to say that this is a beautifully written article by you. And then I think right at the bottom, you've put in some helpful resources for the webinar attendees. You said if you're doing a voluntary separate sustainability report, here is a BDO activation checklist to help you on the journey, 5 steps to that first report. But you've also put in a checklist on TCFD recommendations, which we know is a good place to start, a stepping stone towards IFRS S2. So I compliment you on your article and your useful tools.
Thank you. Aletta, I'll hand back to you, but I'll say, Christine, thank you for joining us. It's been great, and you had some great points there that I think will be very useful out there, which has been good to get a new insight onto the webinar. Aletta, I'll hand over to you to wrap up for the webinar.
Thank you very much. So thank you very much, Kevin. Thank you very much, Christine. Kevin, I think she's a keeper. We'll have to get her back.
Yep.
Talking about sustainability, at BDO, I mean, we are accountants and advisors and auditors. And therefore, from a sustainability perspective, we have identified 5 areas we think we can really add value and assist our clients within our skill sets. So the one is to help clients with carbon accounting or carbon footprint measurement. We're doing some really interesting work, and there's a lot of commonality between what we do in accounting and carbon accounting, financial reporting, and the way you get ready for an audit and looking at the assertions around accuracy, completeness, etc. Very similar. We also have a number of experts at BDO that can help you with a decarbonisation strategy. So once you've got your first carbon footprint, you've started, you've got a footprint, the next challenge is how do we reduce that footprint? So that decarbonisation strategy we can assist with. Now, if we then move to the middle, sustainability reporting includes that carbon footprint, includes that decarbonisation strategy. That reporting, as Kevin explains in his article, could be mandatory in the annual report, or it could be voluntary. So what do we do with a potential overlap? So over time, information from that voluntary separate report will gradually move over to the annual report on a mandatory basis as the ISSB continue to issue their standards. But also sustainability strategy. We've got strategy experts that can help you on getting started. What does a roadmap look like? But also, how do you transform your business to gather this data? And you need data strategy because data is the key element here, and you potentially need technology. And then finally, we've got an absolutely amazing audit service line, and they can help us around assurance. Initially limited assurance over this information, over time reasonable assurance, and they will work with sustainability experts on providing this assurance. So that's the 5 core services that we provide at the moment. There are other services that we can provide. I wouldn't say they are the core. That's the expanded suite of services around sustainable finance, providing assurance and helping with those ESG-linked loans. Sustainable communities, which we often see within local government. So it's not just about the entity, but the whole community. A sustainable supply chain incredibly important around sustainability. A human capital, human rights, diversity, equity, inclusion, human capital management. And finally, learning and development. As you know, at BDO, and Kevin and I, Christine, we are really passionate about education and training. And that's also why we do not only the monthly IFRS and corporate reporting webinars, which is in its 7th year at BDO, but we're also in the 2nd year of doing monthly ESG and sustainability webinars, and currently focusing on carbon accounting. You can subscribe for our insights. So we've got 2 series of corporate reporting insights. that is going out tomorrow. It's already available on our website, but the email to contacts are going out tomorrow. And we've got sustainability insights, which going on Friday. As I've said earlier, we've got these webinars, the ESG webinars, IFRS webinars, but we also have e-learning. And there's a free TCFD e-learning course. So we put in a lot of time in educating and training our clients and contacts and to help them along the way. From an IFRS and corporate reporting perspective, our 6 leaders across the country, please feel free to reach out to any of us or our broader team, a wonderful team of people that can assist you. And if you want to focus on sustainability, and maybe it's decarbonization strategy, and you could always reach out to our sustainability contacts across the country. You can see Kevin is still the contact there for Sydney for IFRS and sustainability, similar for me. Thank you very much for joining us for this webinar. We hope we've given you a lot of ideas, things to consider. The key message is to please start.
Thank you, Aletta.
Thank you, everybody.
Thank you. Goodbye.